Gold isn't rising, the dollar is disappearing. For years, people were told gold prices move because investors get excited. That story feels safe, it sounds familiar, but it's wrong. The real shift isn't happening in gold. It's happening in the unit used to measure it. When gold climbs, what's really moving is the currency underneath it. Here's the contradiction most analysis avoids. Gold hasn't changed, it weighs the same, it works the same. Yet between 1971 and 1980, its price jumped from $35 to $800. That wasn't a miracle rally, it was a 94% collapse in the dollar's purchasing power. Fast forward to today. Currency charts look calm, the euro and the dollar trade where they did decades ago. But that stability is an illusion. It's two weakening currencies masking each other's decline. So when people talk about $10,000 gold, they're asking the wrong question. The real question is this: what does that price say about the dollar? What's happening now didn't start as a shock, it started as math. If you apply the same framework used during the 1970s currency breakdown, today's numbers stop looking extreme. Between 1971 and 1980, the dollar price of gold rose roughly 2,700%, not because gold became more useful, but because the currency measuring it failed. That same percentage move, applied to the current cycle, produces prices that sound unbelievable until you realize they come straight from precedent. Here's the part most people miss. $10,000 gold isn't an upper bound. It's a baseline. Gold has already pushed past historic levels, moving through 4,000 and 5,000 per ounce, without the kind of speculative frenzy that normally marks a top. That matters. Early stages of repricing feel slow. Late stages accelerate. Notice what's happening psychologically. Many investors think they've already missed the move. That belief existed in the 1970s too. Yet the shift from 35 to 800 happened in under a decade, and it didn't rise smoothly. Once resistance broke, repricing turned exponential. So ask the reframing question: if this isn't a bubble but a currency adjustment, where does the math actually stop? Here's where perception becomes the real constraint. Most people can't process prices once they move too far from the past. That's anchoring. Investors lock their expectations to old numbers, then treat anything above them as irrational. In gold, that anchor often sits at $1,200, $2,000, maybe $3,000. Everything beyond that feels like a peak. But the math tells a different story. Early in a move, price gains are hard. Going from 2,000 to 3,000 requires a 50% increase. That's heavy lifting. Later, the work gets easier. A move from 9,000 to 10,000 is barely an 11% change. From 19,000 to 20,000 is roughly 5%. That's the inversion most people miss. The rally feels more extreme as numbers rise, but statistically, it's doing less work. This is why late-stage repricing looks sudden. $1,000 moves arrive faster not because markets go crazy, but because the base has already shifted. The psychological ceiling lags the mathematical reality. And here's the quiet signal. When people say this has to be the top, they're usually describing their anchor, not the market. That's when acceleration begins. Now zoom out, because this isn't just market psychology, it's geopolitics. In 2022, something irreversible happened. The assets of a sovereign central bank were frozen and seized. That single decision quietly rewired the global financial system. It told every country holding dollar reserves the same thing: your savings are only yours if you stay politically aligned. That changed behavior overnight. Dollar reserves stopped being neutral. Treasury bonds stopped being untouchable. For nations outside the Western alliance, the message was clear. If reserves can be frozen electronically, they are not reserves. They are permissions. And here's what replaced them: physical gold, not ETFs, not paper claims, metal held inside national borders. Gold doesn't depend on clearing systems. It can't be sanctioned if it isn't connected. This wasn't ideological. It was defensive. Emerging market central banks started treating gold as a strategic asset, not a trade. The shift wasn't about returns. It was about sovereignty. This is where the story flips. Gold didn't rise because demand got emotional. It rose because trust in the system cracked. And once trust breaks at the sovereign level, it doesn't quietly come back. That loss of trust exposed another problem hiding in plain sight. If countries wanted to move away from US treasuries, where were they supposed to go? The alternatives look safe only until you run the numbers. US debt now sits around 125% of GDP. Japan's is far worse, pushing past 300%. Italy remains structurally fragile. These aren't havens. They're variations of the same risk. So capital ran into a wall. There were plenty of bonds, but very few balance sheets that actually looked solvent. Rotating from American debt into European or Japanese debt didn't reduce risk. In some cases, it increased it. At the same time, fiscal discipline disappeared. Expanding deficits, threats of government shutdowns, policy whiplash. The signal to global capital was simple. The issuer of the world's reserve currency was no longer behaving like a stabilizer. Here's why that matters. When no sovereign bond qualifies as truly safe, capital doesn't rotate. It exits. And it exits into assets that don't rely on repayment, rollover, or political competence. That's why gold stopped behaving like an investment. It started behaving like a necessity. There's proof this shift isn't theoretical. It's already been tested. Russia and China didn't wait for 2022 to start preparing. For more than a decade, they steadily converted reserves into gold. Russia moved from roughly 600 metric tons in 2009 to around 2,800. China followed a similar path, officially reporting at least 3,000 metric tons, with indications that real holdings may be much higher. Then sanctions hit. Predictions of collapse followed. Instead, the opposite happened. The ruble stabilized. The economy absorbed the shock. Why? Because roughly a quarter of Russia's reserves were held as physical gold inside its own borders. That metal couldn't be frozen, it couldn't be blocked, it didn't require permission. Here's the part that resets the narrative. As gold prices rose, the value of those reserves increased by hundreds of billions, effectively offsetting the loss of seized foreign assets. What was supposed to be punishment became insulation. Other nations noticed, not rhetorically, strategically. Emerging markets began accelerating accumulation, not chasing returns, but building balance sheets that sanctions couldn't touch. Once that lesson spreads, it doesn't unlearn itself. There's another misconception that collapses under real stress. Most people think gold only works when inflation runs hot. History says otherwise. Gold doesn't hedge inflation. It hedges failure. During the Great Depression, the most severe deflationary period in US history, prices across the economy collapsed. Debt crushed borrowers, credit evaporated, and gold's purchasing power surged by 75%. The mechanism matters. In deflation, debt becomes heavier, not lighter. As defaults cascade, banks absorb bad loans, balance sheets rot, and confidence in the financial system dissolves. Capital doesn't chase growth in that environment, it flees solvency risk. That's when assets without counterparty exposure matter most. Gold doesn't depend on a borrower paying, it doesn't sit on a balance sheet that can go bankrupt. In the 1930s, the best performing stock on the New York Stock Exchange wasn't a technology firm, it was a gold miner. This is why gold doesn't need inflation to win. It needs instability. Whether the system inflates or deflates, credit-based assets break first. And when credit breaks, value migrates. Something else is shifting beneath the surface, and it's easy to miss if you're watching the wrong signals. Traditionally, gold moves opposite stocks. Risk on, gold down. Risk off, gold up. That relationship made sense when gold was just a hedge. But lately, that correlation is breaking. Gold has been rising alongside equities and bonds, not instead of them. That's not normal behavior. That's a role change. This tells you something important. Investors aren't selling gold to raise cash. They're adding it as a core position. In past cycles, positive correlations appeared briefly during liquidity surges, then snapped back. This time, the accumulation looks deliberate and sustained. Here's why that matters. When gold rises without a stock market crash or a dollar collapse, it means the bid isn't emotional. It's structural. Capital is preparing, not reacting. Notice what isn't happening. No forced liquidations, no panic selling of metals, no rush to exit. Gold is being treated less like insurance and more like foundation. And once an asset becomes foundational, it stops caring about short-term sentiment. That's when repricing becomes permanent. Now look at who's actually buying, because that tells you how durable this move really is. Since 2022, central banks doubled their gold purchases. At the same time, traditional jewelry demand yuan collapsed to record lows. That's a critical shift. Price-sensitive buyers stepped away. Price-insensitive buyers stepped in. Sovereign states don't buy gold because it's cheap. They buy it because they need it. But here's where the picture gets more interesting. Retail demand is coming back. In Japan, small gold bars have gone into shortage. Refiners have paused sales because they can't keep up. ETFs, which had been net sellers for 4 years, started accumulating again for the first time in 5. Notice what's still missing. Hedge funds aren't crowded in. Futures positioning remains relatively light. That means this isn't leverage driving the price. It's physical accumulation spreading outward, from central banks to families to the public. That combination matters. Strategic buyers set the floor. Latecomers add momentum. And when both engines run together, price doesn't drift, it re-rates. Here's the frame that pulls it all together. This isn't about predicting a top or chasing a number. It's about recognizing when the unit of measurement is failing. Gold isn't rising against currencies. Currencies are falling against something that doesn't bend to politics, debt, or permission. That's why the move feels steady instead of euphoric. Structural shifts don't announce themselves with fireworks. They rewrite the baseline quietly. The mistake is waiting for confirmation from the wrong place. People look for a dollar collapse on currency charts, but the collapse is already visible. It's happening in ounces, in weight, in what money can no longer buy. This isn't a trade driven by excitement. It's a migration driven by necessity. And once capital decides it needs a foundation instead of a promise, it doesn't rotate back easily. If you want to understand what comes next, don't watch headlines. Watch where value is hiding. Follow for deeper analysis, because this realignment is only getting started.